Hi. All right, let's get started here with this month's weekly, monthly webinar. This is our monthly webinar in which we review our market outlook and we also review our model, regional, and sectorial allocations. We comment on the different market trends. So thanks everyone for joining today. If you're joining live, if you're not able to join live, then we'll always have the recording available um, tomorrow. For sure, we'll be ready, and you can access the recording on our website, aztlanem.com, on our YouTube channel, and we have the historical recordings there available for review. So, second to last trading day of the month. It seems like we're going to end up with a negative month overall for the month of February, specifically for the U.S. market. All the major indices are down, S&P, Nasdaq, etc. NVIDIA reported yesterday. I think it was a good report, actually, but perhaps not enough vis-a-vis market expectations. There's a report just came out a couple of minutes ago from Barron's talking about the paradox of NVIDIA. It's a high growth and perhaps high multiple company, but it is cheap. We were discussing this same situation yesterday. If you look at the earnings multiples for NVIDIA, it's an expensive company. A lot of growth is already embedded there in the valuation. But if you look at the ROE, it's I think the statistic is the price to earnings is just 10% above the average for the tech sector, but the ROE is 5 times larger. So it's a super profitable company, very efficient, compounding machine, and so it is cheap from that point of view. Earnings were good, but perhaps lower than what market expected, and we're sure what we're seeing is very demanding valuations from this market. So what I'm going to do here is I'm going to put on screen our monthly market view presentation. We shared these presentations earlier during the month. They're available on our website. We share them on LinkedIn as well. We like to do this. I think it's important to keep this dialogue with the community, and this is part of what we review in our investment committee. It's part of the fundamental analysis and considerations for our investments and our investment strategies. So this is prepared at the beginning of the month. We're now at the end of the month. So let's go right into it and see what the view is right now for the month of March and for the rest of the year. First slide, always looking back at the market cycles. We know it's a cyclical nature with an upward trend. We're still showing here the latest recovery from the market correction that we saw post-pandemic with the increase in inflation and the monetary policy response, interest rates going higher. That resulted in a severe market correction, close to 25% in 2022, full year. The average for the last 100 years is almost 30% when these corrections happen, almost I would say 2 per decade, and an average duration of almost 300 days. So this last one was twice as long in terms of the recovery. And in particular for the small caps, the Russell 2000 just recovered to the previous high water mark just a few months ago or even weeks ago. So it's definitely one of the longest recoveries on record. Um, but the recovery was significant, and valuations are stretched. What we're seeing here is a 20-year period for the S&P. We're taking the S&P as a reference, S&P 500. So we're still way above one standard deviation above the 20-year average. So very expensive territory in terms of the price to earnings. The historical average for this period is 16 times. Right now, we're right about 22, 23 times. But that is supported by growth. Earnings growth is also above average. What we're seeing is 14% earnings growth, and the historical average is 11%. The larger companies, the mega caps, so-called Magnificent Seven, for example, that's where the we'll know it's been well established. That's where most of the performance has come from. If we look at the index, very high concentration for the S&P 500, and what we show here is a relative magnitude. Just taking that, the group of the seven companies compared to the small caps. In this case, the Russell 2000 index. Any small move in the mega caps and a rotation into the smaller companies, which have lagged in terms of price action and therefore valuations look more attractive, there could be a significant move in terms of relative valuations. If we look at the valuations stripping out the mega caps, have a similar situation. The market is not as expensive if we remove those mega caps, but still it's closer to one standard deviation above average. Not way above the one standard deviation, but still above average. It's a these are demanding. This is a very demanding market. That's why with an earnings beat, as I was mentioning at the beginning, with an earnings beat, there's still a negative price action that follows right after that. The other thing that's important to consider, keep in mind, is this is a market, especially the U.S. market, especially the larger companies that have evolved into a very profitable and very capital efficient situation. So we have return on equity metrics that are off the charts, that have been trending higher for the last decade at least. Our internal assumption is that this is a product of innovation, um, technological adoption. Companies are a lot more efficient. They can do more with less capital. That's what we're seeing in terms of the return on equity metric. So that's what makes this situation difficult for an asset allocator or for any investor. Yes, the market is expensive, but these companies are super profitable and compounding capital at very high rates. So in many cases, these high valuations can be justified. If we look at the cyclically adjusted multiples, it's the same story. That's a very expensive market, and not only the US, we see the same across the G7. And but I think what's interesting in terms of the price action year to date so far this year, the U.S. market is lagging, and we're seeing some European markets showing very good performance. For example, we're also seeing MSCI ACWI, so that's the global market up 3.3% at the beginning of the month. Um, then outperforming the S&P 500 at 2.7, and some European markets leading the way. The Euro Stocks index up 7%, the FTSE 100 up 6%. In our own experience, the selective Aztlan small and mid cap index at the beginning of the month was up close to 7%, with a large exposure to Europe and Japan. So we're seeing this, at least in the very short term, rotation of the U.S. into other developed markets and even other emerging markets, including China. Gold up 6.6%, and we're going to talk about gold later on in this presentation. Inflation is still a problem, has come down significantly in the US, but not reaching the 2% level yet. With the some of the policies coming out of the White House with President Trump's second term, tariffs, for example, we all know tariffs are taxes. It's a tax increase for the American consumer. That's inflationary as well. So it's a difficult situation from the monetary policy point of view, even though we're in a much better position right now with inflation closer to the target of 2%. If we look at other major economies, Japan, we're also seeing high inflation, but in the case of Japan, it's a positive given the stagflation that we saw over the last couple of decades. So finally seeing some revival there with the weakening of the currency that we saw last year of the yen. We're seeing very favorable conditions there for the exporters, for example, for the tourism sector in Japan. Those sectors could be a positive for the Japanese economy over the next 12 to 24 months. Canada, similar situation to the US. US rates steady at 4.5. And now with the more recent indications that we'll see perhaps a pause in terms of the continuation of the interest rate cuts, given all that we've seen and what we've discussed in terms of the inflationary pressures there. Similar situation across the G20, all the 20 largest economies across the globe, developed and emerging in much more normalized levels vis-a-vis 12 years ago, 12 months ago and 18 months ago. Yield curves mean reverting. We're seeing, for example, in the long end of the curve for the U.S. Treasuries, a sort of a rally there with longer maturity interest rates normalizing the yield curve across the major economies in the world, which should also bring some stability to the global economy. Commodities, we'll talk about gold and oil in a bit. The US dollar in general has continued strengthening, and for the year to date, we're seeing some strong price action for some commodities, agricultural commodities like coffee, some of the precious metals, from gold, silver, platinum, palladium up almost 18%, and then natural gas negative 16%. Oil sort of stable at 1%. U.S. consumer confidence taking a dip, but still at reasonably good levels, and growth at healthy levels as well. Inflation, as we saw, has come down, but there's some indications that the job is still not done, and so perhaps instead of seeing rate cuts, we could see a more protracted monetary policy cycle going forward. Moving on to valuations, and we've been looking at these trends over the last months and a couple of years, and it's part of, we think, part of what's driving relative performance. Some of the European markets outperforming the US, even China, some emerging markets outperforming the US, and this more recent period, relative valuations. The US is just, as we saw off the charts, way above the average and one standard deviation above average in terms of valuations. The rest of the world lagging behind, and this is a trend that has lasted for several years now, as we can see here on these charts. Japan, Europe, MSCI World, ex-US, and emerging markets. All these at extreme discounts relative to the US. Similar situation to Canada, Australia, UK, and the Nordics. And we're seeing very attractive and very interesting investment opportunities there. For us as international investors at Aztlan, we have some very interesting companies in the Nordics and Japan and Australia. And again, these relative valuations to some extent explain the more recent relative performance that we've seen in markets. In this section is where we cover the Fed stock valuation model, starting with earnings growth and earnings growth expectation for the U.S. and for the world. And as we saw at the beginning, yes, the U.S., in this case the S&P 500 with 14% earnings per share growth. That's the consensus. That's the expectation. The historical average is 11%. So growing at a greater pace than the rest of the world. If we look at more or less both the U.S. and the rest of the world companies, at least the indexed companies, growing in a similar trend, but the U.S. outpacing and growing a little faster than the rest of the world. If we compare that earnings growth and the valuation of the markets in terms of the earnings yield, and compare that to the fixed income risk-free rate or the risk-free yield, first to establish what the reasonable level could be, we're looking here at 20-year, the last 20 years, and the historical average. So the 10-year note has been 0.3% above inflation for the last 20 years. So we could say that interest rates are perhaps a little higher than where they should be, but more or less in line with the historical trend. So the risk-free rate or the 10-year treasuries as a reference, more or less where it should be. If we according to the 20-year average, of course, so there's no universal law that says it should be at any level whatsoever. If we compare that 10-year yield of 4.5% with the S&P 500 earnings yield, the inverse of the price to earnings, and we do the same, we say, okay, what's been the average of the equity yield, in other words, the S&P 500 earnings yield over the last 20 years, and how does that compare as a spread over the quote-unquote risk-free rate of the 10-year treasury note, we see that on average, the equity market has paid a 3.5% premium. Right now, we're at a discount, negative 0.04%. So this is another way of looking at how expensive the U.S. market has become. And as I've said in previous presentations, at least three things can happen. One is that the price stays the same for 2 years or 3 years, so that the earnings growth does the catch up in terms of the valuation. The other thing that could happen is the interest rates should move. which wouldn't be uh, something favorable for the market and for the global economy if they go higher by that much. And the other thing that could happen is the price action. And this is what we're showing here on these charts. Price for the S&P would have to go down by 44% to mean revert to this uh, dotted red line that we're showing here on the right hand side. So it's an expensive market. Nothing indicates that necessarily. We need to see an immediate price correction of this magnitude. Earnings growth is there. Companies are very profitable. Um, so it's difficult to argue from the fundamental point of view. Fundamentally speaking, the companies are very strong, but it is a very demanding market. This is another trend that this chart we added 1 or 2 months ago. I think it's important to keep monitoring the return on equity. We see this upward trend for the U.S. companies and a stagnation around the historical average for the rest of the world. So again, this is one of the indications that innovation and technological adoption and efficiencies derived from that really happening in the U.S. and the large U.S. companies, and the rest of the world lagging behind in that trend. Now, looking at the expected returns, what we do, as you may know, what we do is we look at at least three different fundamental starting points: price to earnings, earnings growth, and return on equity. And with this very simple regression analysis, we determine what, with the current expectation in terms of earnings growth, ROE, and the current valuation for the market, what is the expected return based on those regressions? The models are not so strong, as we can see here very graphically on the right chart. I mean, it's all over the place. The model, the average, let's say, says 11.6% expected return with a current P of 22.2 times. But you can see there, we have, for the same valuation level, 22 mark, you can have 40% return, you can have negative 20% return as well. We do the same across the board for the S&P 500, for the MSCI World ex-US, for Europe, for Japan, for Canada, Australia, the Nordics, the UK, and this is the summary of all these different views. Using the forward P, using the expected EPS growth, and using the return on equity as a starting point. What is the expected return, and then the average of the three, simple average. And we can see here for the US, expected return would be 8% for the next 12 months. And then the rest of the developed markets, single digit, between 2.5% to 6% on average, more or less. That's the range that we're seeing. So again, it's a challenging environment with given where we are in terms of the starting point valuations. The selective index, as I mentioned, doing well relative to MSCI World SMID. We implemented some changes to our selective Aztlan index that have so far shown very good results. We developed a stability factor. We reduced the rotation of the index. So a couple of innovations there that are working really well. The AZNR index that tracks nearshoring, the nearshoring theme and the nearshoring companies in the US, Canada, and Mexico had a very bad year last year. This start of the year recovering. And obviously a lot has to do with the trade and tariffs policies that we're seeing out of the White House. We think the companies that are part of the index are still very high quality companies, and we still think that the nearshoring theme will continue to evolve despite these tariffs and announcements and even rhetoric that we've been witnessing. We think the U.S. will continue solidifying as the hegemonic power, and Mexico and Canada as key strategic partners of the U.S. So that's really what the ACNR index represents. We'll see going forward. We'll see. In summary, we think we have a relatively positive outlook, albeit with a smaller magnitude. We're not looking at double-digit returns as we saw. That's really mid-single digits. What we're looking at, the red flag, as we reviewed, is the relative yield spreads between equities and treasuries. But on the positive side, corporate earnings remain very strong, and so we think that could continue to provide some support to the market. Now, the second part of the webinar today, and I'll do this very quickly, is the Aztlan quant model. As you know, Aztlan has 4 steps in our investment process. We have a quant model. That's the first step. It's a model that has been developed over the years, and that's directly aligned with our investment philosophy. So we look at companies that have free cash flow, that can grow, compound capital at high rates, and that have attractive or at least relatively attractive valuations. All these factors are captured into our model, and it's a model that's built from the bottom up, and that's how we come up with the regional and sectorial allocations. And we have this small and mid cap model, and we have the large cap model. So these are 2 very different market segments, as we know. So basically, this is a year-to-date picture. What we're looking here at the factor model performance, free cash flow yield, earnings per share growth year over year, earnings revisions are all positive. Return on equity positive also. But we do see the price momentum having a negative performance at the factor level. So what we're seeing there is a reversal for the 12-month price change segment within the factor, the momentum factor. Earnings yield also seeing a reversal there with negative 2.5% performance as a factor. Now, all these factors form or integrate the Aztlan model and the model rankings, and that is what we're seeing here in terms of the regional allocations. So we're seeing a continuation of the expansion into North America. In this case, the US primarily, but also Canada. And then Europe and Japan. Japan stable over the last quarter, and really Europe showing a contraction there in terms of the model allocations. As we can see here, from the point of view of the 3-month change and 1-month change, absolute and smoother average, that's really what we're seeing is this increase into North America at the expense of Europe, basically. Sectors, I think we're seeing a lot more stability in terms of the sector allocations. The largest sector allocation for the small and mid cap segment, developed markets. This is only developed markets. This doesn't include emerging markets at all. What we're seeing here is financials, the largest sectorial allocation, followed by industrials, and consumer discretionary. We're seeing a slight reduction in discretionary, some expansion in technology, and this is what we can see here in the period over period change. The 3 month moving average, and then just the active allocation, the active current and the active 3 month average. We're seeing these, move into energy, into communication services and financials, at the expense of staples, healthcare, and utilities. That's for the small mid cap. For the large cap, what we're seeing is we're seeing a positive performance for the different factors, including free cash flow, growth, earnings revisions. In this case, even momentum. And this was at the beginning of the month. We'll have to see next week once we have the model updated for the month. I'd be surprised if we don't see this change in momentum, given the market that we've seen for the month of February. And what stands out is the negative performance of the value factor. The earnings yield negative. Also, the return on equity negative. And in this case, we see a similar trend. So the model continues to go into North America, primarily the US, with a slight reversal compared to the last 2 months. But still, at least for this 3-year period, the maximum allocation that we've seen so far for the North American region. And in this case, again, at the expense of Europe, but more so Japan or Asia, developed Asia in this case. That's what we see here in this chart. So an increase in allocation to North America of 16 percentage points, half and half taken from Europe and Asia, developed Asia. And then the active allocations, even though we're seeing this move into North America, the active allocation for the model is still negative relative to the benchmark. So we're negative 11%. So that's another important consideration. The model is going back into the US or North America, in part because of the starting point, which was super underweight the US. Sectors, interesting here how energy was a very big overweight when we were in the pandemic, post-pandemic, and leading into the market correction with inflation and monetary policy tightening, monetary tightening. We're seeing again an increase into energy. Financials remains the largest sector. And I think what's interesting here, if we look at tech, it's also showing a slight decrease there in terms of, as we can see here, 2 percentage points. It's still underweight. The model is still underweight by 15 percentage points, and overweight energy, financials, and industrials. So those show the allocations from our model. Finally, I just want to go over a couple of slides and not to go in any detail here. If there's questions, happy to go over any questions or comments regarding gold and energy, which are the other 2 presentations that I have here. I think we have already shared our energy presentation that was earlier this month. We haven't shared the gold outlook presentation. We'll do that right after the meeting or tomorrow morning. But I think it's of interest given the uncertain outlook and the role that gold has in investment portfolios in that regard. And we know there are major or very successful, even revered investors that dismiss gold as an asset that doesn't produce anything, but it's still a very valuable um, asset that we can use in portfolios, especially when we're looking at uncertain outlooks as the one that we have right now. I think the two slides that are interesting. This one here, I think the change in this trend or in pattern, the the gold price has decoupled from the interest rate cycle. I think this is an expression of the uncertainty that we're seeing, and not only in terms of market valuations and company fundamentals. It's uncertain where the market will go, given that paradox that we have a very expensive market with very strong companies on the fundamental level, but also on the geopolitics and what's happening with Russia and Ukraine, for example, the situation, the evolving situation between the US and China, global trade, all that uncertainty, I think, is what is expressed here in this decoupling. And the other chart here is the cash cost curve. This is an old curve from 2019. It's been a while now, and the historical cost production increase in cost production has been higher than 10%, or had been up until then. So if we extrapolate that, or not even extrapolate that, if we use the 10.5% for this cash cost curve of 5 years ago or 6 years ago, we're looking at a an average price or cost, sorry, of close to 17 or 1800 per ounce of gold. So that can give us kind of like a bottom level or support level for gold. Definitely, what we're looking at is more of the gold miners. This the current price is above 2,000 and the close to 3,000. Sorry, close to 3,000, and the cash cost is around 1,800. Some gold miners could be interesting, but we think that in general the theme or the safe haven as an asset class is interesting for us to review. And then the other final piece that I wanted to show was energy, oil and gas. This we shared some 3 or 4 weeks ago. We're presenting here just a summary of the global energy outlook. On average, a little above $70 a barrel, ranging from 70 all the way to 80. Goldman Sachs being the most bullish. Supply demand analysis. I think the supply is a lot easier to at least think of view. The demand side, I think, is a little bit more complicated with the energy transition. For practical purposes, I think the transitioning will take a lot longer than perhaps was expected maybe 5 years ago. So I think with that, we can assume that a 70, in the range of 70, mid 70s dollars per barrel of oil is reasonable. There's a lot of information here, but I think it's important to monitor the commodity producers, given that one of the sectors that our model is indicating that we should be expanding the allocation to is the energy sector. So with that, this is, I finalize my presentation. If there are any comments or questions, I'll take a moment just to see if there's anything here to review? As I mentioned at the beginning, the recording will be available for the month, for the next month, on our website, and then for a longer period on YouTube, on our YouTube channel. I hope this was useful. You find good information here in what we've reviewed today. If there's no more questions or comments, thanks everyone, and see you next month. Bye.